Hello and welcome back to the Note. Not a particularly comfortable end to the last week before the Fed is due to raise rates. As you can see from this chart here, amazingly the 10-year Treasury yield after an exciting day today is now actually very slightly lower than it was at the start of the year. If we take a look at the World Stock Index as compiled by MSCI, you can see that again we're not back to the lows but selling off quite drastically again. The S&P itself is down almost 2% today despite some good big merger news which keeps people excited. Now, what was going on? First of all, oil continues to collapse after the OPEC meeting, as you can see here. That obviously doesn't cheer anybody up, and it's had a very dramatic knock-on effect on high yield. This is the performance of two of the largest high-yield bond ETFs over the last 6 years, and you can see that the sell-off there has been really quite dramatic, largely because we think because of news that a large mutual fund holding high-yield bonds is winding itself up, generally very much worrying people. That concern about credit transmits itself elsewhere in the system. Now, does all of this mean that we are reconsidering the possibility of a Fed rate hike next week? Barely. This is a chart of the implied probability of a rate rise at next week's meeting as derived by Bloomberg from the Fed Funds Futures market. You can see it tick down very slightly today. It still would require a quite remarkable hit to the Fed's credibility to pull out of raising rates at this stage. You still really need very dramatic negative news from the markets at the beginning of next week for there to be any real chance of that happens. But what plainly is going on, and you can see this also from the moves in emerging market foreign exchange in particular, is that people are getting distinctly nervous as the Fed rate rise approaches. We have one last very interesting week of this year to look forward to.